Hi, I'm Purav Shah and welcome to channel Dezerv. In this video, we are going to talk about tax loss harvesting. Tax loss harvesting is a simple tool that can be used by an investor to make effective use of a loss for reducing the tax to be paid. Now, who does not want to pay less tax? So pay attention as I explain how you can pay less tax with the help of your loss-making investments. Before I proceed, let me tell you about the tax you have to pay when you sell an investment. First of all, capital gains tax, as it is called, is payable only when you sell an investment and make a profit. The capital gain tax that you have to pay depends on the category of the investment and the period for which you have held the investment for. Either it is a short-term capital gain or long-term capital gain. And now the rate of tax for short-term and long-term capital gain is different for equity and debt instruments. First of all, when it comes to taxation of capital gains, remember that long-term capital gains on sale of listed shares and equity-oriented mutual funds are not taxable up to 1 lakh rupee per year. If the gains exceeds 1 lakh rupee, then the base tax rate is 10% for such gains. What happens when you are making a long-term capital loss? You can set off a long-term capital loss against any other long-term capital gains of that same year. If there is no such long-term capital gain, or if the long-term capital gain is inadequate to set off the long-term capital loss, then the balance loss can be carried forward to the next year. And in that year, if there is a long-term capital gain, the carried forward loss can be offset against that gain. In this manner, the loss can be carried forward for a maximum of 8 years following the year in which the loss is incurred. And what if you are making a short-term capital loss? Short-term capital loss of any year can be set off against short-term capital gains or long-term capital gains of that year. The unabsorbed loss can be carried forward to next year in the same manner as long-term capital loss. To summarize, short-term capital loss can be set off against both long-term and short-term gains. On the other hand, long-term capital loss can only be set off against long-term capital gains. Now this brings us to tax loss harvesting. It is possible that you have some investments that are presently quoted at less than your cost. You could either continue to hold them and hope that they go up in value, or you could sell them and stop your loss. This would obviously mean that you would book a loss. If this loss is booked, it can be harvested and when you need it. This means that a loss on a particular investment is used or harvested when the need arises to reduce the taxable gain on some other investment and thereby reduce your tax liability. Now coming to the main part of this video, how do you take advantage of losses made to reduce your tax liability? Let us understand this with an example. Let us say Mrs. Y has an investment in 10,000 units of an equity mutual fund invested at Rs 10 per unit in sometime in May 2019. Thus, her total investment is Rs 1 lakh. Today, the NAV or cost of this fund is Rs 8 per unit. Thus, the value of her investment is now 80,000 rupees. Now, Mrs. Y knows about the tax loss harvesting. She decides that since she is making a loss, might as well use it to reduce her tax liability. She redeems these units and books a long-term capital loss of Rs 20,000. Now in the current year, which will end on March 31st, 2022, she has no other capital gains. So when she files her tax return for current year, she will carry forward this loss to next year, which is 2022-23. In that year, let us say she books a long-term capital gain of Rs 1,20,000 on some other mutual fund or some shares. Now against that gain of 1,20,000 rupees, she can set off the earlier loss of Rs 20,000. Thereby, her net gain gets reduced to 1 lakh rupees. Since long-term capital gains on listed shares and equity-oriented mutual funds are taxable only in excess of 1 lakh rupee, this entire gain of 1,20,000 rupee becomes effectively tax-free for Mrs. Y. Thus, depending on the facts of one's case, you can plan to sell your dud investments, book a loss, and then use that loss to reduce the gain that you can book on your good investments and reduce the tax liability on those gains. Just keep in mind that tax loss harvesting involves transaction costs as it involves sale of your dud investments. This cost should be taken into consideration while evaluating your gain or loss. Hope you found this video very useful, and if you have any questions, please put them down in the comment section below. My team and I will address them for you. My team and I are also here to help you understand how you can save taxes and get rid of bad investments. Do feel free to get in touch with us. Hit the subscribe button below and press the bell icon to watch our next videos. Thank you.